Just when you think the housing crisis can't get any worse, two bombshells are exploding that are changing the entire game, and almost nobody is connecting the dots. First, a distant conflict in the Middle East is causing COVID-like spikes in building costs right here in Australia. We're talking 40% price hikes on key materials, adding thousands to the cost of a new home overnight. At the exact same time, Canberra is finalising capital gains tax reforms that industry models show will wipe another 12,000 new homes off the market every single year. These two forces are not leading to the property crash everyone keeps talking about. They are pushing Australia towards a permanent trap of high prices and high rent. In this video, I'm going to connect the data for you. We'll break down the global shockwave hitting our supply chains, then the political boomerang here at home, and finally reveal what this permanent trap means for your family's security. Let's start with the threat that's flying under everyone's radar, the global shockwave hitting our construction sites right now. And that shockwave is a direct chain reaction. The conflict you see on the news in the Middle East is driving up global oil prices. That instantly pushes up the cost of fuel and transport. Those higher logistics and energy costs roll straight into building materials that are heavy on power and freight. Steel, cement, even the plastic pipes in your walls. The suppliers don't eat that increase, they pass it on. Builders don't magically absorb it either. It ends up in your build, quote, your reno budget, your landlord's costs. This isn't a theory, it's showing up in the numbers right now. Just this month, ABC News and news.com.au reported that for April 2026 delivery, PE resin, the basic feedstock for essential plumbing pipes, has already jumped by about 40%. In March 2026, global consulting firm Ryder Levitt Bucknell told The Australian that if elevated oil prices persist, energy-intensive and freight-heavy inputs are likely to see further increases, including steel and cement. In plain English, if oil stays high, expect another leg up in the price of the core materials every new home depends on. And in that same coverage, Master Builders Australia CEO, Danita Warren, put it bluntly, it feels like COVID again. A code for stalled projects, rationed pulp materials, builders on the brink. This shock is landing on a system that's already at breaking point. Even before this latest spike, the CoreLogic Cordell Construction Cost Index had residential construction costs sitting 35.4% higher than in late 2019. I see that mirrored in tenders and cost reports I'm looking at with clients right now. Builders submitting quotes, then coming back weeks later saying, the numbers have moved again. At those levels, the maths just stops working. Developers look at their feasibility spreadsheets and shelve projects because the profit margin has been wiped. The ones that do go ahead have to load those extra costs straight into the contract price or the rent they'll need to charge to make it stack up, which means ordinary buyers and tenants end up paying for every dollar of this global mess. If you want the clearest proof that supply is about to seize up, look at the biggest player in the game, Harry Triguboff, the Meriton founder who's built more apartments than anyone else in this country. According to Meriton updates and the Daily Telegraph coverage in 2025-26, he has publicly said he's stopped acquiring land in New South Wales. His reason? Construction costs have surged nearly 50% since 2019. His warning was stark, and I want you to hear it directly. As long as the costs remain so high, very little will be built here. When high-rise Harry walks away from buying land, it's not a vibe. It's a hard signal that new housing supply is being choked off. A global price shock is strangling the supply of new homes before they're even designed. Fewer projects get off the ground, more families are forced to compete for the same limited stock, and that puts relentless upward pressure on both prices and rents. That's the first force locking us into this trap. But that's only half of the story. The second force isn't coming from overseas. It's coming from right here, from Canberra. And it's being dressed up and sold to you as fairness. And what does this fairness look like? It's a political boomerang, a policy being sold to you with a straight face that is set to fly back and hit renters and first home buyers right where it hurts. The policy itself is a proposed cut to the capital gains tax discount for property investors. They want to slash it from 50% down to as low as 33%. The government's sales pitch, backed by a recent Senate inquiry, is that this will fix intergenerational inequality. They'll point out that home ownership for 30 to 34-year-olds has crashed from 57% down to 50%, and they'll blame investors for skewing the market. That's their fairness story. Make investing less attractive, and young buyers will finally get a look in. But here's the number they hope you never, ever ask about. Who actually funds the construction of new homes in Australia? Because when you follow the money, the story flips. The answer, according to the Housing Industry Association using ABS data, is the very group this policy attacks. Investors finance 41% of all new homes under construction in the past year. 41%. So, no. This is not some fringe group of speculators. These people are almost half of our new housing supply pipeline. Now, what do you think happens when you start to cripple the primary funding source for new homes? Cutting the CGT discount slashes investors' after-tax returns, so fewer of them are willing to take on the risk of funding new builds, and projects simply don't stack up. And the industry modelling backs that in. Joint modelling from the HIA, the master builders, and the Property Council is clear. A CGT cut of this magnitude would reduce new home builds by approximately 12,000 dwellings every single year and push rents 1 to 2% higher than they would be otherwise. But the real kicker, the damage is already starting. The market is not just reacting to the law, it is reacting to the expectation of the law and the rules changing. Landlords I talk to, developers I work with, are already baking in lower future returns. I've literally got a small townhouse project on my desk where the builder has paused and the funder has said, if the CGT rules move, we're out. Others are nudging rents up at lease renewal, just in case, trying to claw back now what they're scared they'll lose later. The negative effects begin long before the law is even passed, which shows you just how disconnected Canberra is from reality. So let's be clear, you have a global cost tsunami killing supply, and now you have this political boomerang, a self-inflicted wound, killing investment. But here's the question nobody is asking. What happens when these two forces collide? Because they don't just add up, they multiply, and they create something far worse. A permanent trap. So, what is this permanent trap? It's the endgame that happens when the global cost tsunami collides with that political boomerang from Canberra. This isn't an accident. It's the structural rewiring of who gets to own property in Australia. This is the bit no one in the press conferences is spelling out. The proposed capital gains tax reform doesn't just reduce investment, it fundamentally changes who invests. The policy disproportionately punishes the individual mum and dad investors, the people who supply so many of our rental properties and who rely on that tax discount to make the numbers stack up. Meanwhile, it barely touches the big corporate institutional investors. Why? Because they operate under a different tax wiring. And this isn't me guessing. Tax advisory firm RSM Global laid it out in a 2026 report, and it's exactly what I'm hearing in client meetings. When you cut the CGT discount for individuals, the fixed-rate corporate tax structure that big institutions use suddenly looks like the cleaner, safer way to own property. Imagine the government changing the rules of monopoly halfway through the game. They take away the get-out-of-jail-free card from all the individual players, claiming it's for fairness. But the bank, which was never allowed that card anyway, is suddenly the most powerful player on the board. That's how you quietly tilt the whole game while telling everyone you're just leveling the playing field. This policy lays down a super highway for the build-to-rent model. As individual landlords are squeezed out, giant corporations step in to build and hold entire apartment blocks. Real estate firm Colliers reported a record 6,000 of these build-to-rent apartments completed in 2025 alone, with a massive pipeline already underway. In the feasibility packs I'm seeing, whole buildings are designed from day one never to be sold, only ever to be rented. The market is sliding from individual ownership to institutional control. The government's own National Housing Supply Council was already forecasting a national housing shortfall of 79,000 homes by 2029. That number was set before anyone added the CGT changes. Industry models from groups like the Grattan Institute estimate the reform will mean another $9,000 to 1,500 homes per year that never get built. Even if you take the low end of that range and run it for a few years, you're adding tens of thousands of missing homes on top of that 79,000. That's how you end up with a structural deficit comfortably above 80,000 homes by the early 2030s. Not a one-off shortage, but an engineered ongoing gap. Put those two pieces together and you see the real design. This is the trap. You get a pipeline where the new stock is held by a handful of corporate landlords, plus a long-term shortage, so there are always more families than roofs. That combination doesn't just happen. It manufactures a permanent renter class. Ordinary Aussies stuck paying whatever those landlords decide while ownership concentrates at the top. The old middle-class pathway. Buy a modest place, hold it. Maybe leverage into a second one over time, is being dismantled rule by rule. More and more of the supply that does get built never hits the Saturday for sale listings. It sits as a single line item on a fund manager's spreadsheet and comes back to you only as a lease. Picture a normal family in a few years' time in a shiny new build-to-rent tower in Western Sydney or inner Brisbane. Your landlord isn't a retired couple down the road. It's a global fund you'll never talk to. The rent ratchets up because the market is tight and there's a waiting list, but you still can't buy the place. And there's almost nothing comparable for sale nearby because the whole block sits in one corporate portfolio. This shift towards big institutional landlords is a huge change for the Australian way of life. Are you already seeing more build-to-rent buildings or large-scale foreign investment in your city? Share what you're observing in the comments below, because the patterns are much clearer when we compare notes. So that's the trap. It's grim. But seeing the game for what it really is the first step to building your shield. The real question is, what can you do to protect yourself and your family? Let's break it down. So we've laid out the grim new reality, chronic underbuilding, costs through the roof, and big funds quietly buying the stock that does get built. If you're staring at another rent hike or mortgage notice and worrying about the kids' future, you're not imagining it. The trap is engineered. This isn't personal financial advice. It's a way to think clearly in this rigged game so you don't get blindsided, whether you're renting, trying to buy, or already investing. I'm in this every day, seeing the invoices and the policy spin, and I want you looking at it with the same clear lens. For renters, you're on the front line. The rent versus wage charts, tight vacancies, and the shift to corporate landlords tell us relief isn't coming soon. So your mental model is flexibility over attachment. Keep fixed costs low, be willing to change suburb if you have to, and use any extra income and a savings buffer to protect your ability to move, renegotiate, or jump if a path to ownership appears. For first home buyers, many of you have already spent years waiting for the crash that was meant to save you. And it hasn't. Low supply keeps putting a floor under prices. So the question isn't wait or rush in, it's, can I buy without stretching to breaking point? Some buffer in the bank, stable income, repayments I can sleep on. If yes, you trade off on location and property type to get a foothold. If no, you keep renting deliberately and building your position instead of chasing headlines. For existing investors, you're holding something scarce. That's your tailwind, but it doesn't pay the interest. The default is hold and optimize. If the property isn't crushing your cash flow, trim expenses, keep rent in line with the market, improve the asset so you keep good tenants, sharpen your finance. If it's still bleeding you, selling or restructuring is a strategic call, but weigh that against the scarcity you're giving up. The first layer of your financial shield is seeing the game for what it is. Once you understand how build cost spikes, tax changes, and corporate buying flow through to your street, you're harder to push around. My job is to drag that into the light. If you want that view without the PR gloss, hit subscribe and turn on notifications. The knowledge you build here is your best defense in a system that wasn't built for families like ours.